All right, everyone, welcome to the Secrets to Selling Your Business, sponsored by CINA. We're going to cover the reasons people sell, how businesses get valued, some key exit considerations, finding a buyer and some aspects of that, negotiating and due diligence, where I think people really underestimate how to manage those because they can really take a bite out of your valuation if you don't manage them properly, and the same on the tax implication side, and then sort of just wrapping up with kind of legacy and kind of what's next, post an exit to a business. And then we'll leave some time for questions. So just a quick background on me: a serial entrepreneur for over 30 years, raised over 25 million in venture capital, 3 times Inc. 500 entrepreneur, bought and sold 15 businesses, multiple 8 and 9-figure exits. I have an undergraduate degree from Brown University in computer science and an MBA from the Wharton Business School. There really are 4 main reasons that people sell. The first and the fourth are the ones you want. Retirement planning, like, hey, I always knew I was going to exit my businesses when I was 70, 75, whatever, and kind of travel the world, go off into the sunset. Reason 2, it's too hard, or maybe you're losing money and you're having to, fund it from your retirement savings. And so obviously that's the worst case scenario to be selling. I'll talk a little bit how that might drive someone towards an asset valuation, and we'll talk about that. Personal reasons, divorce, health issues, things like that. And of course, the best one you want to have is, hey, this is all part of my plan. I was going to run it until I got to X number of locations and a certain amount of revenue, where I had extracted a lot of value, but there was still value left on the table for an acquirer, and here's it's the right timing and we're going to cash out. So those are the 4 main reasons people sell. So how businesses are valued, it's really 4 ways they tend to be valued. On an asset basis, which is, effectively what it would cost somebody else, kind of a time to market valuation, which is, hey, if I had to create the website and the social media accounts and, get all the equipment and get a lease and a location and all that, what would all that take? And so that's people tend to be that's valued on an asset basis. EBITDA, profit, and cash flow, those don't exactly mean the same thing, but effectively it's the cash flow of the business. I won't get too in the weeds there. Mostly the differences are around tax optimization. So really just think of it as the profitability of the business. So, and I'll talk about why someone might be valued on an asset basis or a cash flow basis in a second. When they are done, it's either done in one of 2 ways. It's either done on a straight basis. So, hey, the business did 2 million in revenue. It did 300,000 in cash flow. It's valued, we're getting a valuation of 4 times cash flow. We're going to sell it for 1.2 million. That's a straight profitability multiple structure. More often than not, though, and this is important to know as a seller, you really want to know not what the business is generating for you, but some estimate of what it's going to generate for the buyer. So just as an example, let's say you as the owner operator is drawing 120,000 a year salary, and someone that's acquiring you has a bunch of locations, and they're going to replace you with the general manager who maybe is going to make 80K, maybe plus some small profit sharing. Well, now all of a sudden that's 40K more. And so if you're getting a 4 times valuation, that's another 160K added to the value, as a simple example. But understanding what the reconstructed cash flow is going to look like for the seller, for the buyer, will give you a better idea about, where you might be able to push the price in terms of valuation. A revenue multiple, so obviously it's just like it sounds. It's whatever the top line is times a multiplier. And then obviously the best case scenario is if you're a strategic acquisition for someone, where someone's going to pay some premium above either an a cash flow or a revenue multiple. So EBITDA multiples are much more common for a mature, profitable business. So if most of the value has been extracted from the business, you've grown it to, let's say 80 to 90% of the capacity, cash flows are stable, you're generally going to be valued on a cash flow basis or a reconstructed cash flow basis. So that tends to be the case. For business that are earlier stage, higher growth, sometimes less profitable or unprofitable because those companies are plowing the money back into the business to grow faster, those tend to be valued on a revenue multiplier. And I'll give you the ranges here in the next slide. So, but where you are in the range that I'm going to provide is going to be based a little bit on, obviously it's in the wellness space, but the size of the company, the growth rate, is there additional upside that has yet to be mined from the business, how profitable, how stable is the cash flow, risk factors. Let's say you've got some pending lawsuits, that's going to affect valuation. The type of buyer, go through the different types of buyers and how the lens they're going to look at you through. And then obviously there are some externalities like market conditions. So trying to sell a business at the height of the pandemic is going to be very different than normal circumstances. So on the revenue side, you're generally going to get between 0.75 to 2 times the revenue. So again, if you were doing 2 million, that means you're going to get 1.5 to 4 million, valuation if someone was valuing you on a revenue multiple. If it's higher growth businesses, those will move up in the range, more in that 2 to 5 times range. If you're talking north of 40% annual growth rates, and then if you're strategic, you can get 5x plus. Now, most businesses that what I'll consider small, and I think, it depends who you ask, but to me, most businesses in the wellness space, unless they've got a giant, footprint of a ton of locations, are going to be under that sort of 10 to 25 million range. So anything under 25 million is generally considered on the smaller side. Most people consider mid-sized businesses all the way up to somewhere between 150 and 250 million. So most of the businesses are going to fall in that small size. So in that 4 to 8 times EBITDA, you will occasionally get higher multiples if it's more strategic or you have a higher growth rate. But I would say for businesses in this space, you're probably going to be under that 10 times EBITDA multiple under any scenario. So growth rate and potential. So again, higher growth rate and higher growth rate is anything over 20, 30% is, again, on a business that's been around for a few years. As so long as the EBITDA is growing, in kind, there should be some economies of scale. So what people like to see is marketing spend being put into the business, because ultimately there should be some economies of scale as you grow. Obviously, the more profitable, the better the margins. Anything over a 20% kind of bottom line margin is considered, really healthy to allow you to sort of deal with the ups and downs of location-oriented businesses, seasonality, things like that. And obviously, the more stable the cash flow, the more it's going to help you on the exit multiple side. And then obviously, smaller businesses, lower in the range, larger businesses, multiple locations, more opportunities for expansion are going to be higher in the range. Exit consideration. So it's probably somewhat obvious, but you really want to try to, as much as you can from the beginning, run your business to be sold. The more you do up front, the easier things are going to be downstream. Now, for most businesses, especially location-oriented businesses, I would say it's unusual that that's the case. But the reality is, even if you're 2-3 years in, you can clean things up. It's very common for people to run for their first 2 or 3 years without audited financials. In fact, I've seen businesses run, 2, 3, 4 years with no financials, which is crazy to me, but I see it all the time. But maybe 3 years in, get a group deal and, have your last 3 years of financials audited, clear key performance indicators, budgeting, budgets where you have performance against those budgets. One of the things I talked about, if you guys are at my, any of you folks are at my talk at CryoCon, is you really should have a board of directors, even if it's just, you and a couple of advisors that have a tiny bit of equity in the business, so that you have those quarterly board meetings. That structure is useful for a few ways. I'll tell you how it can be useful in negotiation and due diligence downstream. But thinking about, putting together a small board of directors, don't need to be more than 3 people. But having those board minutes, your standard operating procedures, and even your employee reviews. Again, it's just good practice. Most small businesses don't do it, but the more buttoned up you are, the smoother the due diligence and negotiation process is going to go. So, what do they say? Measure twice, cut once. The more prep you can do, the easier things will be downstream. 2 main types of acquisitions: a stock sale or an asset sale. There are significant tax and liability implications for which one it is. I will tell you, and I'll get into this a little bit more detail later in the presentation, but almost all transactions, say under 25 million, are going to be done as an asset sale. Almost all deals that are not venture capital funded, or private equity funded, are going to be done as an asset sale. But it's still important to understand, and there are the one-offs where they can be done as a stock sale, and I'll talk about some of those implications. It's also important to understand what type of buyer you're dealing with and the lens they're looking at you and the opportunity through. Are they a financial buyer? Is it more of a buy versus build, speed to market situation? Are they getting rid of a competitor? What kind of a competitor are they trying to get rid of? Or are they strategic? So understanding that will affect how you do negotiation and the due diligence process. This is sort of a subtle point that I think is really important. And this can be true either in reality or in how you spin it in the negotiating process. But it's important, unless you want to be treated like a pure financial purchase, which from a valuation standpoint, you don't want to be. You want the buyer to see some opportunity that you have yet to take advantage of. So in the perfect world, you're able to, your pitch to the buyer is, hey, look, we have a really well-run business. The business is really healthy and doing well. Here are all the things we've taken advantage of. But hey, here's a whole bunch of other things we haven't even had a chance to touch yet. A whole bunch of different modalities we're thinking about bringing in, a whole bunch of different markets we're talking about. And if we just had a little bit more time, energy and resources, we could tap into those so they feel like there's still value to be extracted. That will improve the valuation of the business. And that just goes into the salesmanship of, that negotiation conversation. Focus on running the business really well and have the side effect be having a lot of people interested in purchasing you, increasing the value of your exit and so forth. So again, I would say focus, first and foremost on running the business well. One of the mistakes I see people make is they're, say, 6 months out from when they think they want to try to sell, and they'll try to goose the numbers by, cutting back on staff or cutting back on their marketing spend. And it will improve in the very short term, but deals almost always take longer than you think. And when that gets strung out a little bit, all of a sudden your retention rate drops. All of a sudden, your reviews you're getting some bad reviews. Your new leads coming in are dropping because you dropped your marketing spend. And all of a sudden those key performance indicators right before you sell are going in the wrong direction. And that's going to harm your valuation. So my personal opinion is run the business really well. That's what's going to maximize your value. Be clear-eyed about what a fair value for your business is. I mean, that's part of what we're doing here today. Although we're talking in ranges, one of the nice things about a location-oriented business is while everyone in your geography is a competitor, everybody outside your geography is not, for the most part. I mean, someone might have national expansion plans, but other than that, so if I'm in, Dallas, if I'm talking to someone in Chicago or Tampa or Scottsdale or whatever, those are not my competitors. So when you're going to conferences like CryoCom and you're involved in things like CINA, when you're, going to other wellness conferences or just networking, you want to ask everyone, always offer first, and then people will generally respond in kind, like, hey, here are some things we're doing that are really working good, are really working well for us. And what about you? And, have they thought about valuation? Do they know other businesses that have been sold in their area? Do they know business brokers that, deal with, businesses in that space? So, that way you're coming into the process saying, look, okay, I know that a business like mine should get valued in the, 3 to 5 times revenue range, let's just say. And here are the reasons why I think I can be towards the higher end. And so now when you're talking to a potential buyer and they're saying to you, well, we think we should be, in that sort of, 2 to 2.5 times revenue multiple, you're like, well, actually, I've been talking to people here, and here, and here's what I'm hearing. Is there something, so you come across as a well-informed seller. That's important. You should have a rough estimate. Again, in the perfect world, the exit of the business is planned at least 18 months in advance. You've got time to talk to your board. You've got time to talk to M&A advisors for the tax implications on the business side. You've had a chance to talk to your own financial planning and tax advisors for your own taxes, because there's some things you can really do to help mitigate some big impacts there that I'll talk a little bit about. And say, look, once we get to, total revenues of X or a certain number of locations, then we're going to look to put it on the market and try to sell over the following 6 to 18 months after that. And I can't emphasize this last part enough. Like in life, whether it's, getting a date or getting a job, or, when someone's coming to you, that's, as opposed to you going out there looking for them, you're going to do better, which is why, I'll talk about business brokers in a second. Dealing with business brokers and letting them know, hey, we're not in any rush to sell, but of course we're always, interested to hear what someone has to say. That's a way for someone to be coming to you and also kind of putting yourself out there in a sort of more subtle way. So finding a buyer. Why do people buy? Speed to market. It's really just a buy versus build, or I guess an acquire versus build situation. In that case, you're going to get towards the lower end of the valuation. It's just going to be, hey, look, if I were going to do this myself, build the website, social media accounts, buy the equipment, get the lead, find the location, sign the lease, all that's going to take me X months and let's say $500,000 to get the doors open, whatever it might be. They say, well, okay, it's going to cost me $500,000. Time to market's another $250,000. So 750,000 is the total value. I'm going to discount that. I'm willing to pay 400,000 or 500,000 or whatever. So that's a speed to market valuation. If there's a competitive advantage, let's say you have an unusually strong brand in a given area. You've got a footprint of 3 or 4 locations, and no one else has more than 1 location. So those would be advantages that maybe would get you a premium. Someone wants to eliminate a competitor. Now, there are 2 kinds of competitors that you could be, that a buyer could be looking to get rid of. Hopefully, you won't be this first one. The first kind of competitor is what I call a dumb competitor. The reason, or a lifestyle competitor. The problem with lifestyle competitors are they don't care that much about the profitability of their business, and sometimes they're priced way below market, and therefore they bring the pricing in the market down because people feel like they have to be competitive. So sometimes people will be willing to pay a premium, ironically, for the poorly run location that's not priced properly. But when someone's eliminating a competitor, they're generally looking at it on a reconstructed cash flow basis. So they're looking at, minus the one example I gave where they're eliminating an underpriced competition, they're going to evaluate it on a reconstructed cash flow basis. What's it going to generate for them once they acquire it? Pure financial buyer, again, they're just going to look at the stream of cash flows, and then it's just a negotiation of, on a reconstructed basis, it's going to be, hey, what's it going to generate for me once I take it over? And what am I willing to pay? Am I willing to pay 3 years worth of that cash flow, 4 years worth of that cash flow? It's very unusual to see someone pay more than 4 years of cash flow for a business that's under 10 million in revenue. And then obviously the best is if it's worth more to them than to you, it's going to be some premium over reconstructed cash flow. So, that might be, let's say, someone's trying to really have a big footprint in Texas. They've got a footprint in Dallas. They've got a footprint in Houston, but not yet in Austin. You've got a 3-location footprint in Austin, and they're willing to overpay for you on a reconstructed cash flow plus a premium because they want to get a foothold in Austin and they want to do it quickly. The 3 main kind of buyers are someone who's a competitor, and they're either looking to eliminate a competitor, dumb or otherwise, or they're just trying to expand their brand with lower startup costs. If it's the first one, we've already discussed that. If it's the second one, that's going to be, more of a buy versus build valuation with maybe a little bit of a premium because they are taking out a competitor. And depending on where you guys are geographically with each other, in relationship to each other, and where your pricing is with regard to each other's pricing, might get a little bit of a premium. But that's buyer number 1. Buyer number 2 is someone who's a new entrant. They're new to the space. Again, generally going to fall into 2 categories. Maybe it's a customer who has fibromyalgia or arthritis, and it's really important to them personally. They've got the capital. They're looking for something to keep themselves busy. They're really passionate about the space, and profitability is not that important. Someone like that might pay a bit of a premium especially if you're a known quantity to them. They like the business. They know the business. They know it's well run. They might pay a bit of a premium. And then the traditional business person that's really looking at it more like on the financial side, and are they going to be able to grow it? And more like I guess the way a private equity mentality might be, which is, hey, can I put additional fuel on the fire and grow it and be able to get a better exit multiple? Hey, maybe I'm buying it at 3 times. I think if I make these adjustments at a second location, third location, I can get to 5 times, as an example. And then obviously, as I mentioned, strategic buyer, whenever possible. Strategic's the way to go. Whenever possible, you want to have a competitive situation, even a perceived competitive situation. I remember when we were selling High Beam Research, which was an 8-figure exit back about 15 years ago. We were selling, at the height of the financial crisis, in 2008, and we basically were able to create the perception that it was a competitive situation, when it wasn't, and it probably doubled our valuation. So strategic buyer, they were both strategic and they saw it as competitive. So they thought, like, if they didn't buy us, the other player would, and that really helped us quite a bit. And then one question I get a lot is, should I use a business broker? Generally, if you can find a business broker that has experience and connections in your space, then the answer is absolutely. We did, 10 or so acquisitions in the call center space at a company called Exact Telesolutions that I ran. And in that scenario, all the deals we did were done through a business broker because they had networked with all of the owners in the call centers all over the US. And so it was constant lead flow from them. Now, the way they generally get paid is if you're doing a single transaction, you're generally going to pay them on a, they're going to get some kind of upfront fee, usually in the 10 to 20K range, to put together the deal book, to start doing all the cold outreach and stuff to the people, some of the people that they don't know as well, and some people they know. So that's generally a 10 to 20K, and then what they call Lehman formula on the back end, which is generally it's 5% of the first million in value, 4% of the second million, 3% of the third million, and then 1% up for the fifth million and beyond. So you're generally paying somewhere between max 5%, sometimes on a blended basis, more like 2.5%, all to be negotiated. Obviously, if you were as a seller, it's a single transaction, so you can't negotiate. But if you're on the buying side, sometimes you can buy, like we did. We were buying a lot of businesses. We negotiated lower rates, but all can be negotiated. So negotiation and due diligence. The thing that's important. So due diligence basically is anytime someone's going to buy you, you're talking a 7-figure, 8-figure sale, they're going to want to look under the hood and they're going to want to look at everything and understand that the due diligence process for the buyer is designed to lower the purchase price. That is literally their main goal, is to, because ultimately the way it's going to work is you're going to have a letter of intent or a term sheet with a clear understanding of how the business is going to be valued and some other key factors which we'll talk about in a second. But so let's just say you agree that the business is going to be valued at 4 times reconstructed cash flow, reconstructed in this way. Let's say that's what's in your term sheet. The due diligence process is going to be like, well, hey, yeah, that's what we agreed to, but you've got this pending liability over here, this lawsuit over here, and we didn't realize that, you guys hadn't maintained the equipment as well as you said you did, and blah, blah, blah. And so we want to reduce it to 3.5 times instead of 4 times, as an example. So understand that's the process. And that's why being as buttoned up and prepared as you can possibly be is so important. The second point is one of the more subtle ones, but again, doesn't matter whether it's a date or a job or selling a business or selling a car, whatever. People buy from people they like and people they trust. So building rapport with the buyer is so important, especially because, and I come to this later, every deal I've ever done, both on the buy side and the sell side, the deal has cratered in what I perceive to be an irreparable way 3 to 5 times. I've never once, in the 15 plus transactions I've done, had the deal be like, hey, we put a letter of intent together, we did due diligence, we signed this asset purchase agreement, and everyone went their merry way. Never happened. Every time, 3 to 5 times minimum, the deal's cratered. I thought there's no way it's going to get salvaged, and the deal went through. So just know that's part of the process. So the better your rapport is with the buyer, the better you're going to be able to navigate those ups and downs. As I mentioned, sign a letter of intent or term sheet is what they usually call it, with a really clear understanding of as much of the detail without any legalese whatsoever. This should be the most simple, straightforward business language about you're going to value it this way. Here are the liabilities that it's going to be done as an asset purchase deal. Here are the liabilities that are going to be assumed. Here are the employees that are going to be retained, all of those things. The other thing that I think is really important to do is to insist on a breakup fee if they exit the deal without cause. So, and then not huge, but look, they're going to start spending money the second they start doing due diligence, in that sort of, high 4 to low 5 figures, accountants and lawyers and due diligence folks, and their time and attention as well. But so are you. And it's also a distraction, to the employees. It makes everyone a little nervous when there's discussions about the business being sold. I'm going to talk about the equity thing here in a second. But, having a breakup fee, again, it would only apply if they pull out for no reason, meaning they do due diligence and everything in due diligence was exactly as you represented, and they still decide, oh, we couldn't pull the capital together or whatever it might be. They have to pay some kind of breakup fee, 20K, 30K, not some crazy number, but something that where they have a little bit of skin in the game, because you don't want tire kickers when you're having people come into your business. The point I make here about employees having equity, I think a lot of small businesses make the mistake of not giving their employees some modest amount of equity. Now, I think oftentimes to keep it simple, they'll do it as a profit share or some kind of bonus. But the reality is, if you give people equity, let's just say you set aside 5% for everyone in the company. I would always make the argument that you will increase the value of the business by well more than the 5% of the equity you gave them. And by the way, even if you allocate 5%, you're never, ever going to give the full 5% away, and I'll explain why. Two things are going to be true. One, you're not going to allocate the full 5%. You'll give, maybe you'll give 2% to the general manager and 0.5% to people doing sales and marketing stuff, whatever it might be. They're all going to have 4-year vesting, where the first year is cliff vesting. So until an employee is there for a year and a day, and even if you gave someone the full 5%, they wouldn't retain the 5% unless they're there for a full year and a day, and then they're only going to retain 25%. So the beauty of doing something like that, and as long as you write your operating agreement properly, you can buy it back at fair market value if they leave or if they're fired for cause or things like that. So there's all kinds of things you can do to protect yourself. But the other, I think, happy unintended consequence is when you get ready to sell the business, now all of a sudden the employees aren't freaked out about selling the business, because they know when the business gets sold, they're going to get a little kiss on the cheek in terms of some of the proceeds of that sale. So can't emphasize enough how important I think that is. Understanding why someone is buying the business will often give you kind of where in that range people are going to pay for, which is why I covered that. So really try to spend some time. That's why building rapport is another reason why building rapport is important. Try to understand as much as you can about them, their background, how they view business, how they view your business, how they view the industry, because it will really help you sort of massage your pitch, if you will, to maximize your exit value. The most important thing about selling is not needing to sell. The better your business is doing from a cash flow perspective, the easier it's going to be to find a buyer, the easier it's going to be to negotiate a fair price. As I said earlier, don't cut corners to try to pump up the value, and try to get the timing just right. It's kind of like trying to time the market with stock. Anyone trying to buy at sell at the very peak and buy at the very bottom, it's a fool's errand. Same thing with businesses. Run the business well, run the business profitably, thoughtfully. Another reason why having a board is useful. But the other reason a board is useful is you can use them as a bad cop in your negotiation. Look, my board is never going to accept the price, lower than a 3x multiple or 4x multiple or whatever it is, or a dollar amount. So, your board could be helpful in that respect. Obviously, intellectual property doesn't apply itself generally to this space. Maybe you build some, special app there. There's a possibility that you could, but in most cases, the competitive moat that you might have that someone might pay a premium for is maybe you've got a super strong brand in that market. You're the only one with a bunch of locations. Everyone else a single location. Maybe you have an unusual and really appealing customer base. That's a big part of your thing. Maybe you're charging premium prices because you've gone after the right target. So there are some things there that might make you worth a little bit more. And the last thing I'll say on the valuation side here is, if you do seller financing, it can really help increase the purchase price with some important caveats that I'll get to. So what that means is, let's say someone offered you $5 million for the business. We're going to pay you $1 million at close, and then they're going to pay you $1 million a year over the following 4 years and pay you the full $5 million. So if you are going to structure a deal that way, because they're not having to raise the full $5 million, effectively you're lending them the money. You can charge them interest on that money. You can add that to the purchase price. That's generally how it's done. So you're going to get 12 to 15% interest on the $4 million in this case while it's being paid out. Make sure there's some kind of provision to recapture the business in the event they run it poorly, but I'll come back to that. The goal of due diligence is to lower the purchase price. So one of the ways you can protect against this is a sales technique that we use when we sold High Beam Research to Cengage. What we did was we said, because we knew there was the financial crisis was happening. We knew valuations were getting chopped sometimes in half from earlier term sheets. We'd heard that. So to protect ourselves against that, we created a perceived competitive environment. And the other thing we did was we said, hey, look, we're leaning towards you in this transaction, but if our revenue is exactly what we said, and our cash flow is exactly what we said, and our agreements are exactly what we said, is there any reason you would want to adjust the price? So we take them to the future. We basically cover every last thing that they could possibly have an issue with, at least at a reasonably high level. And when they said, nope, if all those things are true, we're going to honor the agreed to letter of intent purchase price multiple. That makes it really, really hard for them to come back and, later after they've had that, you've taken them to the future and you've had that conversation, for them to say, oh, actually, now that we said, now that we're, into due diligence, we only want to pay 3 times and not 4 times. In fact, that was one of the reasons the deal cratered, was they tried to renegotiate. We told them to go pound sand. The other thing that's important is the timing of it. So as I mentioned, we did it on purpose, meaning the timing of the business. We knew we had done a bunch of things on the marketing side, and we'd really seen a lift in our revenue. We knew that was going to continue. So knowing where we were going to be in 6 months when we started going to market, we were squeaky clean during due diligence. Everything was ticked and tied. We gave them everything, every number they could possibly want, and all of it was as we represented. And the second thing we did was we had our 3 best months in the company's history in the 3 months prior to sale. So even though a lot of companies were getting a 50% haircut on their letter of intent valuation, we got our full valuation. Yeah, we had to walk away from the deal a couple times, but we got our full valuation. If there are any significant liabilities, again, in most cases, the buyer's going to insist on an asset sale anyway, with a line item assumption of liabilities that are in the asset purchase agreement. But if you were going to do a stock sale, understand that if there are any outstanding liabilities, that's going to significantly affect the purchase price. One of the things I see people get wrong in the letter of intent and in their asset purchase agreement is they don't call out any cash and cash equivalents on the balance sheet need to be added to the purchase price. If you don't cover this, I can guarantee you when you get close to close, they're going to be like, oh no, of course the cash is ours. So you might have a business with, $400,000, $300,000 in working capital. And they're thinking that that's, that they're going to take that. You need to make sure that you call that out in your letter of intent, that it's the revenue or the EBITDA multiple plus cash and cash equivalents is the purchase price. And the last point here is don't be in a rush. Who's ever the one that's chomping at the bit more to get a deal done loses in the negotiation. Whoever seems a little bit more thirsty, a little bit more in a rush, they're the ones that generally lose in the negotiation. They're the ones that blink in the negotiation. This is what we did with Cengage. So there's almost always a data room, which sometimes is a very sophisticated piece of software with all kinds of tracking and stuff like that. But it can also be as simple as just a Google Drive where you upload all the documents. It's going to have all your financial statements, employee reviews if you have them. Again, my advice here is you want to bury them in every last scrap of data so that there's no question that their answer to their question isn't in the stuff that's in the data room. Again, they've signed a non-disclosure agreement. They've got a breakup fee if you've negotiated it properly. And the more buttoned up you seem, the less they're going to question whatever you tell them. So, can't emphasize that enough. Consult with both your board and your M&A tax folks on how to structure the deal in a way that reduces taxes. I'll come back to this in a little bit, but roughly 20 to 40% of the purchase price is going to go to taxes. And where in that range you fall is often based on planning. Someone is paying those taxes. So if it's you, you're going to want to increase the price by that amount of taxes. If it's the buyer, they're going to want to decrease the price by those taxes. So someone's paying those taxes. Make sure that you optimize the tax treatment of the transaction, and both you and the buyer will benefit. As I mentioned before, I promise you every deal will crater 3 to 5 times before it closes. Just know that's part of it. Don't let yourself get worked up. Try to keep your emotions out of it. If you do, understand that for most transactions, there's going to be an escrow account for some number of months, even if it's an asset sale and not a stock sale. And there's only line item assumption of liabilities where they're going to assume payroll tax liability. They're going to assume, customer contracts, things like that. They're going to want some amount of money. So let's say the company sold for all cash for $3 million. They're going to assume, hey, look, we want $500,000 left in escrow for 6 months, just to make sure that all the representations and warranties. So all asset purchase agreements are going to have representations and warranties both for the buyer and the seller. If you have misrepresented anything or warranted anything is part of the due diligence, they can go after what's in escrow based on a violation of the reps and warranties in the asset purchase agreement. So just understand that that's fairly standard. This last point, when we were doing the call center, we did a roll up in the call center space. We did about 10 acquisitions, something like that. And all but one of them went smooth as glass. The one that didn't go smooth was our fault. We knew during due diligence that the seller was being shady, and we thought we were so clever because we structured it as an asset purchase agreement. I think we only paid, it was like maybe a $3 million transaction, and maybe we paid $750K up front, and the rest was in a seller note. And we're like, hey, if he's lied to us, we'll just offset the seller note and we'll be none the worse. Well, the problem is that's how a rational person thinks. So he did, misrepresent a whole bunch of things. We had to replace a whole bunch of equipment. We offset the seller note, but then we ended up in depositions in courtrooms for the next 18 months. And while on paper, because we had seller finance and we were able to offset the note and we did ultimately prevail, it wasn't a terrible deal, but it was a huge distraction. And this comes back to the fact that, yes, you want to make sure all your documents are buttoned up and all that. But if you wouldn't do the deal on a handshake, maybe don't do the deal. We didn't trust this guy as far as we could throw a building. We shouldn't have done the deal with the guy. Tax implications, as I mentioned, 20 to 40% is going to go to the transaction, and that's if it's structured. It could be towards the high end if it's structured poorly. You could be the low end or even lower than the 20% if you do some thoughtful things. And again, I'm not going to get too down the rabbit hole here. I'm just going to cover a few high level things. LLCs and S corps, it's pass-through capital gains, usually in that 15 to 20%. This is going to be long-term capital gains, because you're going to have held the equity for more than a year. If you're a C corp, so generally angel-funded, self-funded businesses are going to be LLCs or S corps. And if you're VC-funded, you're almost always going to have to convert to a C corp in order to take VC funds, and then you're going to get double taxation, no getting around it. There are some things you can do to defer some of the taxes, but you're going to pay more if you're a C corp. And a sole proprietor, you're going to pay ordinary income tax, so that's the worst case. So only a fool would remain a sole proprietor all the way through a transaction. Asset sales generally benefit the buyer for a couple of reasons. One, they're not assuming any liabilities, especially hidden liabilities that might not show themselves, or if there's some pending lawsuits that weren't disclosed and it went past the escrow period. In an asset sale, you're not having to worry about that because you're only assuming line item liabilities. They also get a step up in basis on the depreciated assets. So let's say you had a whole bunch of equipment that the seller had fully depreciated. If it's done as an asset sale, the buyer can get a step up in value, so they can depreciate those assets again and reduce their taxes going forward. Stock sale, again, if you're VC funded, much more likely you're going to be a stock sale. There, you've got the liability issues if you're the buyer. So what that means to the seller is there's almost always going to be, in fact, the 9-figure exit telemedicine company we had, their escrow was 2 years, and that was in an asset deal. So if you do a stock deal, you can have a 3, 4, 5 year escrow where you're not going to get the full amount paid out because they've assumed until all liabilities have been cleared. So stock sales can get a little bit messy when it comes from that. I will say it's very common that you start as an LLC, you self-fund or raise angel funding, and then you convert to a C corp as you bring in venture money. Very, very common. There are some things you can do to help spread out the taxes. And this last item here, there are some cool things you can do with an installment sale from a personal standpoint that allow you to do things like, let's say that I was the owner operator and my net on the whole transaction was $2 million, then I would take maybe $250,000, pay capital gains taxes on that, leave the $1.75 million remaining in there's special trust you can set up, and that money can then be, you could buy Bitcoin with it, you could invest it in another startup business, you could put it in a mutual fund. There's all kinds of things you can do. So again, talks to tax planners, both personally for yourself as well as on the M&A side, and you'll be able to really reduce your taxes both for you and the buyer, which help benefits everybody. Last couple of points just to wrap up here. Try to make sure your key people are taken care of. Like I said, whenever you're bringing somebody into a business, I would say most of the transactions we've done that I've done in my career when I've been on the selling side, there's been at least 2 and sometimes as many as 4 times that potential buyers have come in and done due diligence. And it disrupts the business, especially if the employees don't have equity. everyone's, starts looking for another job because, well, hey, if it gets bought, I don't know, I'm still going to have a job. So understand there's a real soft cost to that. So if you can do things, especially your key employees, and when Cengage, purchased High Beam Research, they did that, where basically, part of the negotiation was a 2-year stay bonus for me. So I agreed to stay for 2 years. They were going to pay me an additional bonus. Now, in a smaller business, I think 6 months is much more likely, but basically, giving people, the key people, maybe the person who's doing all your sales and marketing work and the person who's your general manager, maybe having those people guaranteed employment for 6 months, and continuation of any bonus plan they have and things like that, will calm people, because otherwise it could be really disruptive to the business. And those people are going to help sort of calm down the people that are under them. So make sure that your key people are taken care of. And even little things like salaries or titles. If you're going to make an adjustment in a title or an adjustment in a salary or adjustment in a bonus plan, do it before you go to market. Once you are under a term sheet, there's always a provision, if they're even slightly sophisticated, that you can't make any material change to the business. You can't change your pricing. You can't change people's salaries, titles, bonus plans, any of that. So do it in advance. Make sure that your people know that you're taking care of them, and it's the right way to treat them anyway. They helped you get it to an exit. You should make sure that they're taken care of. If there's a seller note of any kind, make sure you can take back the business or come back and reoperate the business if they start to wreck the company. So you might be familiar with, Dave Portnoy bought Barstool Sports back from ESPN for, I think, $1 after having sold it to them for, I don't know, something like 500 or 700 million, something crazy. Now in that case, it was a little bit different reason, but ultimately, you can put things in there where, hey, look, I'm okay financing, your note, but if you're mismanaging the business, like, hey, look, business revenue and profitability has been steady for the last 2 years. If there's more than a 35% dip in my example on revenue, I come back in, I manage the business, I have all operating decisions, or you sell it back to me for, 20% of the purchase price, whatever. That there's some kind of way to gain control back. And again, I can help you talk through the different ways you might do that if someone's interested in talking those through. And again, try to be planning 18 months out if you can. It'll save a world of headaches downstream. As a founder, you're almost never going to go with the business other than some transitional period. So again, minor thing, but try to prepare yourself mentally. I know when Cengage purchased High Beam and after I was, after my 2 years, I did a 2-month around the world trip, and then said, hey, you know what, I'm going to reset and come back. Look, you're the boss. That's how you're used to being treated. And there's a little bit of a mental shift. So, I think that doing something like that to kind of reset the clock is a useful exercise. And then this just from my own personal standpoint, one of the ways that for me when I've exited businesses and had a decent result, I made small investments in early stage companies where I liked the people running it. I liked what they were doing. It was a way for me to stay kind of mentally engaged, and maybe I had a board position, whatever. So I find that stuff's, really helpful. And now I'll open it up for questions.
First question, what's your take on selling a business but staying on as an employee? I know you just touched on that now, without full control. Have you seen situations like this, and what are your thoughts on how it can work?
It gets really messy, right? People can't serve two masters. I've almost never seen it work. What I would say is, I think that in the case of a significant seller note, that could make more sense, now that you mention it. Where, hey, look, okay, I'll let you put down 20%, $1 million on a $5 million purchase in this example. But I need to stay on. I'm going to be in 3 days a week and, overseeing the operations, making sure that the KPIs are all being managed properly, that things are going well, that the customers are happy, so that I know I can get that $4 million payout over the next few years. I think that's probably the scenario where it could work the best, because there's a reasonable alignment of incentives. But I think it's going to be pretty tough if, Lars, if you were selling the business and you used to calling all the day-to-day shots and I'm the buyer, now all of a sudden I'm making a decision on pricing, let's say, that you don't agree with and stuff like that, and you're kind of mumbling under your breath to other employees. Like, it's hard for that stuff to work. And generally, I can't say it's impossible. I haven't personally ever seen it work, but hey, I could always be surprised.
And then Dave, just on that, just kind of a follow-up question. When buying a business, do you think it's a good idea to keep the current employees, or do does a new broom sweep clean? In your experience, what have you seen? Or was that just a too broad question?
No, it's not too broad at all. Look, to me, people are generally going to buy businesses, unless it's being purchased under duress. So it's two scenarios, right? So it's a fire sale. The business is losing money or barely breaking even, and they're doing a whole bunch of things wrong. In a case like that, maybe it is a clean house kind of situation, right? But that's when, that's more of a fire sale situation. When a business is being sold, that's being well run, the buyer, and I would say the buyer, the seller, especially if there's any seller financing, and the customers for that matter, want as little disruption to the business as possible. I mean, in fact, you don't necessarily even want your customers to necessarily know. I mean, I know in businesses like yours, you guys have personal relationships with some of the customers and your friends as well as, as them being clients. But I think as few of them, as the mainstream customers knowing that the business is being sold, the better. So I think it's better to keep the team intact when the business is being run well, and maybe cleaning house if the business is being run poorly.
Just one more question here. What do you think about bringing in a partner as an investor to inject funds and give a startup style business a boost? How have you seen this impact the company's operation and revenue growth?
Yeah, so I did cover this when I was talking about this in the CryoCon presentation that I did. So I'll repeat it here. Is I think that even if you could, let's just say that startup capital to get the business to profitability was $500,000. Just pick that number out of thin air. If that were the case, you always want to raise 2 times the amount of money your bottoms-up budgeting and forecasting model tells you you're going to need. And even if you could self-fund the whole $1 million in this example yourself, my strong advice would be to not do that. It would be to bring in at least one cash investor. So with small businesses, what I see work the best is you have 3 board members: the owner operator, some cash investor who hopefully has some operating experience, if not in the space you're in some adjacencies. Maybe they've helped sell businesses before, so they've got some M&A experience. They've got some personal interest in you and your business. And they're also another set of pockets to go to in the event something like COVID happens and you have a black swan event, if you will. So it's not just your capital at risk. So whenever possible, you want to spread your risk and have an investor on your cap table. So I think that's useful. And then the other thing it will do is, because you've got, and then the third board member would be someone who's industry specific. So they've got, and maybe it's not in a wellness business, maybe they have experience in expanding a gym franchise or something like that. So having a 3-person board, one person that's got some financial skin in the game, and you're doing quarterly board meetings with those folks, talking through all of the things that are going well and things that aren't going well. So I would say always bring in more cash when you can, especially if you can get the right valuation. So people will often ask me, hey, if I'm raising capital, what valuation should I do it at? And that's not the right question to ask. The right question to ask is, what valuation can I get? So if I can get a good valuation, I should take as much capital as I could possibly get. So part of it depends on the valuation you think you're going to be able to drive, and that's going to be based on the perceived, business plan and exit plan for the business. But if you can drive a high enough valuation, I take as much capital as you can get.
Another question. Thank you, Kelly. Another question, the breakup fee. Can you expand on that breakup fee? That's a fee you're charging, I take it, to the person looking at the business.
That's exactly right. So again, a lot of people don't do this, especially in smaller transactions, and I think it's a mistake. Because like I said, it's disruptive to the business and again, you're not asking them to pay you the breakup fee if you've made any kind of misrepresentations during the negotiation part, when they do due diligence. But you say, look, if during due diligence, there are no material, facts that are different than what we presented up front, then, you don't get to pull out of the transaction. Because ultimately, part of what they're going to do too is, and people, buyers will often misrepresent, that they actually have the capital liquid. So, to actually do the transaction. So it's very common that people will kick the tires, look for the business, try to negotiate the best deal they can, and then try to raise the money to do the transaction. Because it's a quid pro quo. They're going to ask you to have a lockup period. Okay. If they're even mildly sophisticated, they're going to say, once we sign a term sheet, you can't shop this. It's called the no shop provision. You can't shop this deal to anyone else. It's usually 60 days. I try to negotiate for 30 or 45. 60 is common. People will ask for 90 or 120. I would never agree longer than 60 days because that means they're trying to raise the capital. But asking for a breakup fee is like, hey, look, if you've misrepresented the fact that you've got the money ready to go, and assuming everything I've said is exactly as I've represented it, and you decide to pull out just because you don't feel like doing the deal anymore, not for any material reason, then you've got to pay me $20K.
And do you base that on a percentage of the breakup fee, or is that also too wide a range question to ask? Is it specific percentage or?
Yeah, I mean, look, so the way to think about it is, what can you, it's the highest number you can say with a straight face is the short answer. The pragmatic answer is, you're generally, is for a transaction of this size, you're probably going to have a hard time getting more than say 15 to 25K as a breakup fee. If you make it too much higher than that, they're going to spend money on lawyers to not pay you the breakup fee. So you want it to be enough that it's, better than a stick in the eye. Okay, now I got 15K, I can plow into marketing and, try to, get my wind in my sails again. But not so much that they're going to fight too hard over it. I mean, in a perfect world, you'd get them to put it into escrow. I've rarely seen that, especially on a small transaction size.
Okay, thank you. Another question. What's the best way? You shared a couple of ways to evaluate the business. What's the best way, in your opinion, to evaluate a business that's either breaking even or not doing so well? Person wants to get out.
Yeah, it's going to be based on a time to market asset, asset value. That's how people are going to value a business like that. You can try to spin it otherwise. I mean, the best way to try to spin it, right? So if it were me and you said, okay, Dave, I have a business that's barely breaking even. I don't see a path to real profitability, but I want to get the best value I can. The way I would try to position it, although it's an uphill battle, I'm not going to lie, is to basically like, man, if I only had another 15K a month, 10K a month to do in marketing, which unfortunately I don't, because silly me, I didn't have enough startup capital when I started. But hey, you do. If I had another 10 or 15K a month, here's all the things I do, and we'd be doing double the revenue we're doing now. So that'd be the way I would try to spin it, but it's a tough sell.
Because I mean, that's the reality. Some businesses aren't doing well, and it could be a management problem or even an employee problem. The person coming in may see that, obviously, to the buyer's advantage, because they're getting a business that's not doing well. They're going to highlight those things. But it's, in your opinion, is a business not doing well still sellable?
It is, just not at the price you probably want, right?
Yeah.
So again, the way they're going to value it is on a discounted time to market basis. So again, let's just use round numbers, slightly different than what I used before. But if it took me $1 million to get the business launched and run it, to meaning if the total cash I would spend from the day I decide I'm going to do it to the business is profitable was $1 million, then I'm going to be willing to pay you some discount on that $1 million, a 50% discount, a 60% discount, a 40%. So I'm going to pay you somewhere between $350 and $700 on that $1 million, because otherwise I'll just do it myself. If you want me to pay you close to the full $1 million, screw it, I'll just do it myself and not have to deal with any headaches or transaction issues. Then what I would say to your earlier point, Lars, is if the business is being poorly run, one, the seller is probably going to be in a hard place to be like, yeah, I suck at running a business. I'm sure you'll be way better at it than me, and it'll probably do way better than you than it's doing for me. Look, a buyer is looking for, in due diligence, is looking for a reason to lower the price. And the business is being run well, you've given them all the ammo they need. You're not going to get a premium. You're going to get a discount. I don't see any real way around it, other than, like I said, the one angle you could argue is, hey, look, and I'll just give you an example. Let's say, for example, you had 1 month a year ago where you plowed an extra 15K into marketing. In that month, you had twice as many new customers come in, as an example, right? You could take the position, look, I just didn't have enough startup capital and I got it launched. And so, but you're much more well financially healed than me. You could give this the gasoline that it needs to be able to grow better, which I don't. And so it's going to do way better for you than it's done for me. Again, I think that's, you might get a little bit of an uptick in valuation from that, but it's a tough argument.
Okay, and then last question, Dave. We are out of time, but I do have a last question here. You mentioned giving equity to employees was a great idea. Is that at the point of sale, or you're giving equity before you even decide to sell?
No. You want to do it because the thing about it is, again, because there's 1 year cliff vesting, that's how you should structure it. So until they're there a year, and if they were to leave in 364 days and you gave them 5% of the business, they would retain 0, right? So it's, as an owner operator, if you can't tell in a year that someone's worth the equity you gave them, that's on you. So you want to give them the equity as early as you possibly can, and then you claw it back if they leave or you fire them or whatever. And that way, you get the full benefit of it, because ultimately you want them to feel like an owner. If you want to make them act like an owner, you have to make them an owner. So no, you give them the equity up front. The other benefit is, if you give them the equity later, there are 2 problems with that. One, they often have to pay an exercise price. So they're actually having to come out of pocket to exercise the options, number 1. And number 2, they're going to get ordinary income tax treatment. But if they've held that equity for a year and a day or longer, they're going to get long-term capital gains treatment. That's a huge difference. They're going to pay, 20% at the high end if it's capital gain, long-term capital gains, versus, 40% if it's, 39-40% if it's ordinary income. So no, you want to do it early.
And then, Dave, you also said that it was a great idea to do that. What makes it such a great idea, to give employees that equity?
Because I think that, they're way more likely to act like an owner, And so, as an example, right, what I do in all my businesses that I've ever run is I do quarterly board meetings with my board of directors. And then the week after my board meeting, I do an all hands company meeting, and I review effectively the same presentation I gave the board, because I want my employees to feel like I, as the owner operator, am accountable to them in the same way I'm accountable to the board. And as shareholders, I am accountable to them. And so now when they see how well the company's doing, now instead of feeling, oh, gee, great, Dave's making more money for himself, good for him, they're like, oh, yeah, Dave's making more money for himself, but he's also making more money for me. So now all of a sudden, when you're talking about the performance of the business, and, it also helps you, when it comes to, salary and bonus stuff too, which is, hey, look, most people don't have equity in their businesses like this. Go ask your friends that work at other, similar type businesses. None of them have equity in them. So it's a way for you to differentiate. It's a way for you to push back on obviously you want to pay people fair market value, but, people who are looking for maybe a little bit more on the salary and bonus side than could make sense. Equity sort of a way to push that, push back on that, if you will.
Okay, we have come to our end of our time. Great presentation, Dave, as always. We appreciate you and the time, and we're going to be seeing a lot more of Dave Guttman, and we got some announcements, to make in the near future. So, stay tuned and watch this space for details. Thank you, Dave, once again.
Thanks, everybody.
Thanks, Nick. See you guys.
Thanks a lot. Thanks for listening, Dave.